YouTube, what it do? It's your boy Young Soros here, back with another video. In today's video, we're going to be going over what is going on this week in the markets and moving forward. And I want to talk about something, guys. Inflation isn't going away. Yes, I know. You're seeing prices go down and things like that. But I want to show you guys something, and it's looking real spooky. And if this trend continues, in we can see inflation go back all the way up to 8% again. And if that happens, we're in for a bad day. Drop a like on the video and let's get right to it. So, inflation isn't going away. And why do I say this? Because if you look at this chart, oil is starting to climb. As of recently, it has been trying to break out of this range. And if it starts breaking out of this range, easily can go up to 120 and 130, which is the peak of it around this area here. Peak right here in April. In October, you came down. Oil was around 90, even though you had 8% inflation. And if oil starts to trend upward, that is not a good sign, as oil was one of the main drivers as to why we had such high inflation with gas prices. And if you guys don't know, Joe Biden has been trying to do things to make gas prices lower, but he can't keep up these policies forever. So with that being said, you got to keep in mind oil is starting to climb right now. As we take a look currently, oil is up around 1%. Pretty decent, but it's been stuck in a range for the last 6 months, 8 months. So to see it start breaking out and start going crazy and potentially hitting 90s, that is not a good sign, guys. That is not a good sign at all. Not at all. And then if we take a look at the US dollar, and the US dollar also shows high inflation as it peaked the same time the CPI inflation print came out at around 8.9%. The US dollar peaked right here. So to see the US dollar trend up as well, that is also not good for equities, the stock market, and things like that. Risk on assets as the dollar starts climbing up, that is lessening corporate margins for other companies. So you do not want to see a strong US dollar, as it will make things more expensive for US companies overseas, and their profit margins will be smaller. So keep that in mind when we're talking about this stuff, guys. You see these charts go up, the US dollar, the oil futures, and then you see the bonds selling off. This will worry you about the equities market or where we would go from here. If this trend continues, we could easily hit 430 and potentially 420, go back to those levels, and then we'll see where we go from there. But as of right now, you need to keep an eye on slash CL, which is the oil futures, and then you need to keep an eye on the US dollar. The US dollar is extremely important to look at. If this trend keeps continuing and it gets all the way up to 30, and even if it hits new highs, then we could see bad things happening in the equities market. And if the bonds keep selling off too, that will just exacerbate the problem, as these two feed off each other like a feedback loop. So the bonds keep selling off, the dollar will keep rising higher, and the higher the dollar rises, the more the bonds keep selling off. So you gotta stay prepared, stay flexible. I got a couple plays that I want to make and I'm looking at currently, but we're gonna get into a minute. But another thing I want to talk about is that the Fed is going to have to raise higher for longer if oil and energy and these inflationary things keep coming back. So if the Fed plans to raise higher for longer, that means we're going to be going possibly all the way to 80. We might go to 85, and we might go below 91, which is the lows of last year. And as of the current trend right now, it is looking like we are going to hit 90, test 90, and then we're going to go all the way down to 85, and we'll see where we go from there. And if it gets 85, that's where the bonds can get real spooky and things will start breaking. We're already at levels where we had the banking crisis of this year in March. So if we're already at those levels, then who's to say what would happen once the bonds start breaking these lows here at 90 going all the way to 85? That is not a very good sign. And if you're in the equities, once again, you want to keep an eye out. If the bonds keep going lower, then equities are going to get crushed as they are a risk on asset. And imagine if you get 5% up to 6% for a risk off asset. You're not going to take the SPY, you're not going to take Nvidia. No, you're going to go to the bonds. So they're going to sell off the stock market, and then it is just going to go bad from there. So keep an eye on that. And then if the Fed keeps raising rates higher, that is also going to exacerbate the US dollar problem, which is going to further make it even harder for corporations to beat their earnings, which is going to exacerbate the entire problem, and it's just going to be one big mess. So guys, keep that in mind when you are going into these trades and looking into the economy, because if the bonds keep selling off, you will see some fireworks start happening. And currently we had a little relief rally down here, relief day down here, but if it breaks down here, who's to say what can happen next? So one more thing I want to talk about. If the Fed, now, there's two things that can happen here. We are probably either in stagflation or the recession is further out than we think. Now, let me explain. Usually, before a recession, if we take a look all the way back, we could take a look all the way back to when most recessions happen. Before most recessions, you would see a rise in oil and then an instant drop before most recessions. And I can't go back all the way. Well, actually, I can. So you had the 80s inflation crisis, oil rose, boom, recession hits, oil drops. You would see oil rise and then drop before the recession starts. Same goes for here. You saw the rise, you saw the drop right here, and then the drop going in and out of the recession. So if oil doesn't drop and keeps continuing, maybe we're not in the recession yet, or maybe we're in the back burner of it. You can see in '08, once they called the recession halfway through, oil hit a new top and then sold all off. So oil is a pretty good indicator as to when the recessions usually start and where are we in the recession, depending on how you go about it. As you can see, even in 2020, but 2020 was a little bit different. But even in 2018, you had the rise and you had the drop following the taper tantrum. So keep that in mind when you guys are watching oil. Oil can be a very good predictor as to, where we are in terms of how close the recession is, because oil usually starts selling off once we start getting into the thick of the recession, and it starts selling off hard. So oil currently is rising, and if it keeps continuing this trend, maybe we're not in the recession yet, or maybe we're in the back burner of it. But just keep that in mind. And if we're in the back burner of it, then that is a really, really bad sign, because that leads into stagflation. And you do not want stagflation in your economy at all. I'll get into a whole breakdown of how stagflation can cripple an economy and can be worse than a recession. But for now, all you need to know is that stagflation is not what anybody wants, and that is what the Fed is trying to avoid. The Fed is trying to force a recession, but they don't want to call it that. So if the Fed can't force a recession, you're going to have high inflation, and then you're going to have a slowing economy, which causes stagflation. And if you get those two things, you're inevitably going to end up in a recession. But you want to skip the stagflation part, because that is where damage can be done. So you want to skip the stagflation part and go straight to the recession, so that way you can reset the inflation rate. So keep that in mind. That is the Fed's overall goal. The Fed is trying to raise rates as high as they can to get inflation under control and cause a recession. Because once they cause a recession and slow down the economy, then that's where inflation can start going down and see a not an uptick in trend, but more or less a steady pace of inflation at 2%. So if they can't force a recession and we're going to end up in stagflation, they're going to have to raise rates higher, which is going to sell off the bonds even further. And then, yeah, so keep that in mind. So keep all this in mind. Let's get into the next topic, guys. We're going to be talking about the things I'm watching right now. And the things I'm watching right now are the chip makers, more specifically NVIDIA. Now, we've talked about NVIDIA a lot on this channel. Oh my God. Ugh. You know what? Am I tripping? Yeah, so we talked about NVIDIA a lot on this channel, but one thing to know is that NVIDIA is usually a leader or a lagger. So what this means is NVIDIA, AMD, the chip makers, they are usually the first to run or the first to sell off. And once we see these stocks start falling hard and start breaking lows that we haven't seen all year, then that's where you can start making your plays and then assess like, okay, where is this going from here? We have a double top right here after the earnings, and they didn't break above this, so I'm assuming it's going to drop back down maybe here and then sell off further. It could bounce, could drop back, but once you start breaking the highs of the first major rip of the earnings report, that's when you can start getting worried, and that's when you can start looking at the market might want to sell off. But AMD, NVIDIA, chip makers, things like that, those will lead the stock market up or down. So depending on which way they go, it could be an indicator as to what is going to happen next. Keep that in mind. Another company I'm going to be watching is XOM. Now, XOM is an energy related company, and as you can see, they're coming up to almost the highs of last year, all the way in October, where they had this huge rip. They're coming up to the highs of February and between March. And once they get up here, that's where, if they start breaking out, that's where this comes in. And then once they start breaking out, you can make your play. I'm going to be getting into those. I want to see if they drop a little more or if they have a down day first before I get into the XOMs. But keep that in mind. That is one trade I am looking for as time goes on and things like that. So another trade I want to be looking at is the bonds. Now, contrary to popular belief, I don't want to short the bonds. I don't want to short the bonds because, as you can see, it's already at pretty low levels as we speak, and shorting it from down here would just be silly. So my plan is to see where things go, see how Powell wants to maneuver the situation, and depending on what he does, if the recession hits faster than we think, then that is a good time to go in and start buying up bonds, start buying up the bond yields, start buying bond futures, things like that. But as of right now, I don't want to sell the bonds. I've been shorting the bonds all last year, and I tried to buy the bonds this year, but I got clapped, obviously. But for the most part, you want to buy the bonds, at these prices. They're really attractive, and I can maybe front run these bonds, but it is really risky to try to front run the bonds and front run the Fed because, again, you don't know what they're going to do or say that can upset the bond market and the curve and all that sort of stuff. But one thing that is known is that when a recession starts, or during the recession, that is where bonds start taking off. And if you can get in before the takeoff, then you can make some pretty extraordinary gains. So keep that in mind. But this is another one I am watching, the bonds, and then finally the US dollar. I'm going to keep an eye on these because once it starts breaking out, maybe the 29.50, which is around right here, then maybe I will start, buying some calls and things like that, or start getting in. Or maybe if it drops way down here again, I might start shorting the dollar again. So we'll see what happens with all this stuff going on. Keep in mind that other things affected too, like China. China's data is coming out. It's really bad. So that could be having a push-pull effect on the bonds and the dollar. So keep that in mind when you guys are looking at all these stuff. There's different economic factors and macroeconomic data coming out, and it's all gonna hit at once, and all the data is coming out. But you got to know how to maneuver and decipher the data. Some data might be relevant, some of it might not be, but the data is going to be more prevalent than ever now due to the fact that Jerome Powell at Jackson Hole, he said nothing. He just read the script once again. So the markets are definitely going to be more jumpy on good or bad data. Too bad data or too good data, that could be bad for the markets and the bonds. And if the bonds start moving off of data and hold that move, that is not good. So that is it, ladies and gentlemen. If you guys liked what you guys saw or heard, drop a like down below, comment and subscribe. And if you guys want to know anything, just ask and I will try my best to deliver. It is your boy Young Soros. Peace out.